Principles of Accounting, Chapter 9. So in Chapter 9, we start talking about liabilities. Liabilities are money that we owe to others for payment of assets or like inventory, supplies, equipment, and any services. If we have payroll expenses, notes payable, all of those things are liabilities. So we have long-term and current liabilities. So the definition of what is current and what is long-term for liabilities is the same as what is current and long-term for assets. Current liabilities are due within 1 year or the company's operating cycle if longer than 1 year. Remember, that's rare. Long-term liabilities are due after a year or longer than that time. What usually ends up in long-term liabilities are items like mortgages, notes payable, anything that we would pay over multiple years. We're going to focus mostly on current liabilities within Chapter 9 and then long-term liabilities in Chapter 10. What is our uncertainty in liabilities? Well, sometimes we have an uncertainty in who is going to get paid, when they should be paid, and how much to pay. And we're going to talk about some of that uncertainty in liabilities at the end of this chapter when we talk about things like warranty expense, where we have to estimate how many of our customers are going to utilize the benefit of the warranty. Or there are some payroll expenses, such as vacation expense, that we don't really know when that's going to happen. We have this liability that we're providing paid vacation for our employees, but we don't know which employees are going to take vacation when and how much vacation they're going to take. So that's where that uncertainty in liabilities comes from. We also have liabilities that have very exact amounts, like our accounts payable, our sales tax payable, any unearned revenues, short-term notes payable, and some of the payroll liabilities. As I said, vacation and bonuses and stuff are estimated liabilities, as we'll see later in this chapter. So we're going to go through a wide variety of transactions that happen in current liabilities. One of those is sales tax payable. So if we sell inventory or services, as a company, we are responsible for collecting the sales tax amounts on those. Then we're responsible for paying the state for those sales tax amounts that we collected. So we can see here that in this transaction, we have a 5% sales tax that we collect. In Iowa, the sales tax is anywhere from 5 to 7%, depending on which county you live in. So we have our cash, our sales, and then our sales tax payable. Then on August 31st, we would record that sales tax payable, and then quarterly, we pay those taxes to the state. We've talked about unearned revenues in previous chapters. So unearned revenues are when we collect cash but haven't provided the service yet. This example here is a great example of unearned revenues. So we sell concert tickets long before the concert ever happens. But until they perform the actual action of that concert, that is a liability that they have to, at some time, either give our money back or perform the service that they promised to perform given that liability. Short-term notes payable, these are very similar to notes receivable. So it's a promise to pay an amount in a future date. We have interest. We can just borrow money from the bank. We might use them on an overdue account payable, similar to when we were looking at the accounts receivable and our customers took out notes receivable to pay for an account receivable, we also have that option to take care of an account payable. But instead of receiving money from the note, now we're paying notes. So here we have a note to replace our existing $600 account payable. So we have a 60-day 12% note for $500. We have to record interest and when we pay the note. So here we pay the note plus interest. Remember, our interest calculation is the amount of the note times the interest rate times time, whether that is in days or months. In this example, we borrowed money from the bank. So on the day that we borrow money, we receive cash, and now we have an obligation to pay the bank back that cash that we're borrowing. In this, we have a 60-day 12% $2,000 note. So when it gets repaid on its maturity date, we pay the note plus the interest expense with cash. Notes also have to have an adjusting entry. So when a note extends over 2 periods, then we need to record an adjusting entry to record that interest expense for our matching principal. So if we are doing yearly adjusting, so on December 31st is our adjusting entry, or we're doing monthly adjusting, so at the end of every month, we would have an adjusting entry. So in this example, we borrowed money on December 16th for a 60-day note. On December 31st, we have to record an adjusting entry to acknowledge that interest expense. And then when we pay the note on the date of maturity, we would repay the principal and interest. We would have the interest payable, the interest expense that has accrued since our adjusting entry, the amount of the note, and then the cash payment. Next, we're going to talk about payroll deductions and liabilities. So we have payroll liabilities in that we need to pay our employees. So salary and wages. We also have any employee benefits such as vacation or bonuses, sick leave, any payroll taxes that we are responsible for. Employees and employers both pay payroll taxes. The employer maintains those payroll taxes on behalf of the employee and remits them to the state and the federal government. So what does that look like? Well, here we have some examples of payroll deductions. Our gross pay is the amount of money we get paid before any deductions are taken. Then we have various deductions for income taxes, our FICA taxes, which are medical and Medicare and Social Security taxes, and any voluntary deductions. Items that fall under voluntary deductions are if we're contributing to a retirement account, if we are taking the employee's health insurance, and so we pay a portion of our health insurance. Those are examples of voluntary deductions. First, we're going to talk about FICA taxes. So we must withhold FICA taxes from our employees' payroll and then send those to the Internal Revenue Service every quarter. So what comes out in our FICA taxes are Social Security and Medicare. It says what the rates are as of 2018. So with many of the payroll tax amounts that are withdrawn from your check, those amounts, much like tax policy, is set by Congress, and Congress can change those policies. So it's always been 6.2%, but the amount earned in the year has changed throughout the years. It keeps increasing. And then Medicare is 1.45% of all wages earned in the year. With Social Security, once you pass $128,400, you stop paying Social Security for that year. And then you restart in January until you get up to $128,400. Then we also have income tax, federal income tax, and state and local income taxes. We withhold based on what our withholding allowance is, and then for state and local taxes, different states and different localities will have different rates that are withheld. The federal income tax rate, what gets held from your check, depends on whether or not you're married, whether or not you have children. You can also withhold at a higher rate than the government recommends based on whether or not you're married or have children. You can be exempt sometimes if you don't make a certain amount of money or aren't married with any dependents. For state taxes, most states have income tax. There are just a handful of states that don't have any income tax for their employees within that state. Wyoming and South Dakota are the two that come first to my mind. And then local income taxes, some counties and cities have income taxes. This is not the most common occurrence, but it does occur.